Systems for accounting for inventory. Periodic system and perpetual system. Perpetual system. How does it work? The perpetual system tracks each item by using a designated inventory subsidiary ledger page. The subsidiary ledger page has a date column and three main sections. One section is used to record purchases of inventory, another section is used to record the goods sold, and the third section is used for the balance. The beginning inventory is there from the previous period. It matches the physical count that is taken at the end of the previous period. Each purchase is recorded in the purchase section as number of units, cost per unit, and total value. This purchase is added to the previous units in the balance section to get the new balance in units. The same thing is done to the value in dollar amount. When goods are sold, they are recorded in the goods sold section and then deducted from the ending inventory. At the end of the period, the balance of the subsidiary ledger is matched with the physical count to make sure that there is nothing missing. It provides detailed information about each inventory item. At any point during the period, it can provide the number of units, cost and dollar amount of each inventory item. However, the problem with the perpetual system is that it needs more work to track all the items. It does not work with numerous products except with the use of computers, because it is practically impossible to track numerous products manually. Here's an example. Imagine a supermarket. You see customers are paying for purchases and leaving smoothly. Now let's assume that no computers are used and one customer bought only 3 items and wants to pay. All the cashiers are not going to be used, as only one will have the subsidiary ledger of inventory that includes several thousands of pages, one page for each item. In order to search for the page of each of the 3 items, record the sales and calculate the balance, it might take more than an hour. Most probably, this will be the first and the last customer. If computers are used, each cashier is connected to the server where a database gathers and updates such information in a fraction of a second. How are merchandising transactions recorded using a perpetual accounting system? Let's assume that the business bought product X from a supplier for $1,000. The terms of payment is 210 net 30. When goods are purchased, they are recorded in the inventory subsidiary ledger of product X and the balance is updated. So what does 210 net 30 means? It means that the business could take 2% discount if it paid within 10 days, otherwise it would pay the whole amount in 30 days. If the business pays the amount within the discount period, which is the 10 days, it would take a $20 discount. The entry would be debiting the accounts payable by the full amount, as the business owes nothing to the supplier after paying the amount due. Then inventory account is credited by $20 and cash is credited by the rest, which is $980. If the business didn't pay within the discount period, it would pay the full amount. In such a case, there is no discount, and the accounts payable is debit and cash is credit for $1,000. Let's now assume that the business sold 12 units of product X to customer A for $80 each, with terms of payment of $315 net 45. As the business is using the perpetual inventory system, the inventory subsidiary ledger of product X is updated by recognizing the number of units sold and updating the balance. The cost of goods sold as an expense is debited by $600 and inventory is reduced by crediting it by the same amount. But what about the sales? The sales revenue should be recorded, but it will be recorded using the selling price. Sales revenue is equal to $960. Account receivable is debited by $960 and sales revenue, which increases by being credited, by the same amount. The terms of payment in this case means that the business is ready to give the customer a discount of 3% if payment is made within 15 days. Otherwise, the full amount should be paid within 45 days. Now let's assume that the customer paid within the discount period. The discount is equal to $29. The account receivable is credited by $960 as the customer does not owe the business anything after payment is done. Cash is debited by $931 as cash is received. Sales should decrease by debiting it by the amount of that discount as the sales are now less. However, this is not the correct practice. If we do that, we won't know how much the original sales is and how much the discount is. That is why we debit a sales discount account, which is a contra-sales revenue account. Its normal balance is debit and it increases by being debit. The sales discount is later subtracted from the sales to get net sales. By this method, both the amount of the original sales and the amount of the sales discount is known. The sales discount is debited by $29. If the customer didn't pay during the discount period, no discount is granted and the full amount should be paid. In such a case, cash is debited by $960 and account receivable is credited by the same amount.